while today we'll be looking at how the auditor uses internal controls, and we'll continue from there, hopefully to round up the audit approach, chapter 6. Okay, please confirm you can see my screen. And for those that joined us apart from Samuel, can you confirm you can hear me very clearly? And you can also see me. Please confirm. Somebody should please confirm apart from Samuel we've been conversing with.
It's loud and clear.
Okay,
Visible
and am
enough,
I
visible enough.
visible enough? Okay, fantastic. Thank you for that, KU. Thank you for. All right, I can see your emojis. Appreciate that. I appreciate that. Thank you. Thank you. Okay, so the core idea behind the auditor using internal control is that a client has a strong internal control system, and the auditors can rely on testing those controls instead of performing substantive procedures. So if controls are strong, it is assumed that substantive testing will be limited. It will be limited because the internal controls provide credence to that system, that whatever it is that has been run on that system that culminates in the financial statements production would definitely be okay. So that's the idea. So once the system of internal control is strong, robust, it's effective, then substantive testings will reduce. The risk of material misstatements is assumed to be lesser. So it's important to note that it makes the audit more efficient, focusing efforts on higher risk areas, because the challenge with internal controls has been addressed by management. And when auditors can rely on internal controls, then they focus more on area of high risk. So the auditor's responsibility based on ISA 315 ensures that the auditor must gain an understanding of the 5 components of internal control framework. So if you don't understand internal controls, then you cannot place confidence, comfort on those controls. So auditors should understand the 5 components based on the COSO framework. Talking about the control environment, we've looked at how to perform risk assessments, information systems, control activities, monitoring. So these 5 components has to be deciphered comprehensively by the auditor for him to be able to place reliance on those internal controls. So we also need to document the relevant features of the controls the auditor is working with. And placing reliance on them, you need to confirm understanding of those controls through walkthrough tests of key transactions. So, for example, following a sales invoice or payroll transaction from initiation to recording to reporting, whether it's an ERP or the system, the company, the system, the ERP, the electronic resource planning, the enterprise resource planning the organization is using, the auditor needs to confirm how it works. So what we do is we give them access. Most organizations that use external auditors that are tech savvy, we give them access to our ERP to be able to understand how the system is. So whether it's Sage, whether it's QuickBooks, whether it's Tally Prime, whether it's Dark Easy, whether it's Peachtree Accounting, whichever package you use, you should be able to understand this as an auditor to be able to audit it. So for example, looking at sales invoice, how it gets to sales invoice, maybe there's a sales order, there's delivery note, then the invoice culminates in payment and all that. So whatever way it is the ERP works, the first thing is to confirm your understanding as an auditor of that system. So why walkthrough tests? The walkthrough test helps auditors to check if the control system is correct. So the control system is correct when the auditor understands and he has checked and tested it to see if actually those controls operate as designed in real life processing. So transactions can be tested after the walkthroughs and understanding of the system by the auditor. He also needs to assess control effectiveness. 2 factors on control effectiveness speaks to the design of those controls. Do they look strong on paper, but actually in practice they don't work? So there may be policies on those controls, internal control policy, but then it doesn't work. So the auditor needs to ensure these 2 factors are they on paper? Can they prevent, detect, and correct material misstatement as designed? Or are they just on paper and they don't work? So, for example, all purchases above 1 million naira requires the chief financial officer's approval. So the implementation of those controls, you ask, are they actually applied in practice by staff and management? So very important graphical illustration of this example of controls. And also, if the CFO regularly signs blank approval, then the control failed or it has failed. So we need to test this, because the impact on the audit approach is that if controls are effective, the auditor may reduce substantive testing. But if they are not effective, the design are there, but implementation has not been fostered or has not, from our test, been guaranteed to work, then the controls we'll have to ignore the controls and go through substantive testing. This is key. So take note of that. But where you've tested 1 or 2 transactions and you've seen that the controls are effective, the auditor may place reliance on that and reduce substantive testing, and also adopt a system-based approach, which is a bit lesser. So take note of this, and it will help provide understanding on how to approach these substantive areas of audit testings. Also, if the controls are weak, the auditor must perform more substantive tests, check transactions, maybe samples, balances, disclosures directly to have that level of comfort and to cover the areas of work that are supposed to be done. So key takeaway is that auditors don't just trust, we verify. Somebody said, don't just trust as an auditor, you need to verify. You must understand, test, and evaluate every control to ensure that that control is working. Then that would inform our decision to reduce substantive testing. So the extent to which auditors rely on internal controls shape the entire audit strategy. This is very important. So that's how the auditor uses internal controls to address his work. So any question on this? Any question? And please, we'll be running, but please feel free to interject when you have a concern or you have a challenge with any of the thoughts we are providing. So please feel free to interject and let's address your concerns. Okay, so that will be the end of this unit, and let's look at the next unit, speaking to the audits or the auditor's evaluation of internal controls. How do we evaluate internal controls as auditors? The first one is control risk assessment. You evaluate internal controls firstly by control risk assessment, and the high control risk or a high control risk speaks to controls are weak or ineffective, while a medium or low control means controls are strong and effective. So where you have a high control risk after your testing and your assessment, then the auditor cannot rely on the system-based approach. So you shift to detailed substantive testing of transactions and balances. So it's important to note that where you've come to a conclusion that controls are weak and if ineffective, then you have to go into test of details, substantive procedures. Then for the shifts to detailed substantive testing and testing of transactions and balances, you need to understand that that ascertainment or assertion from your conclusion that control risk is high must be substantiated and documented. So take note of it. Then where you have a low control risk from your assessment, you should also document it, showing that controls appear well designed and are effective on paper. So in implementation, they are effective. On paper also, it's fine with you. Then the auditor must test controls to confirm they work in practice. So effectively, the auditor can reduce substantive testing where controls are low, control risks are low. So you can reduce substantive testing or eliminate even the top substantive testing based on the level of comfort you have on those controls. And you can now rely on the system-based approach. So testing controls speaks to relying on the internal controls where the auditor performs tests of control to confirm proper functionality of the system. Testing those controls, for example, if the company has a rule that all payments above 500K needs CFO approval, the auditor will test a sample of those payments to confirm that this actually has existed and is existing or is being performed. 500,000 naira, you see the CFO approval or his stamp or something. And if you've tested like 10, you can properly say that control actually operates or works. So you may need to continue substantive testing even if control risk is low, because when controls are strong, the auditor never relies 100% on them because the inherent control system limitations has areas like human error, mistakes, management override. Management may even bypass those controls. So it's important to, instead of doing detailed substantive testing, out of those 100% population, you could just do 20% to validate the fact that the control is okay. So substantive testing may need 70 to 80% coverage of the population depending on the data you're analyzing. But then with 20% where you're satisfied that the control is strong, then you can go ahead with 20% to have that level of comfort that at least you've checked for human error, mistakes, management overrides, and where management may bypass controls, you could see it with 20% population coverage. So it's very important. So also the area of collusion and fraud. Collusion and fraud. Two or more people can work together to beat the system. Yes, that's a general risk for internal and external auditors. So auditors always perform some substantive testing before forming an opinion on the set of transactions they are working on. So key takeaway on this is that the evaluation of internal controls help the auditor decide how much to rely on the system-based approach or the substantive testing. So where we have weak controls, you do more of substantive testing. You have strong tested controls, a mix of system-based and a little of substantive testing. So substantive testing can never be eliminated completely. You have to employ it where you have doubts and to also foster a level of comfort in doing your job properly as an auditor. Okay, so that's how the auditor evaluates internal controls to decide the level of substantive testing based on weak control risk assessment or strong control risk assessment, speaking to high control risk or low control risk. Any question on this unit? Any questions? Okay, I believe we're deciphering it properly and we're getting the idea. Okay, so let's look at the summary of the approach to reliance on internal control. I think this should be the last section. Summary of the approach to reliance on internal controls. So the auditor's reliance on internal controls follows a logical sequence. So in understanding how to rely and placing reliance on internal controls, the auditor follows this guide. This roadmap is provided. Number one, understand the system. You can't audit what you don't understand. So you need to understand the system clearly, comprehensively. So you obtain, based on ISA 315, an understanding of the client's internal control system. Very important step. It includes the processes, and that's through interviews you can ask, please walk me through your process in this unit, walk me through your process in this unit, and all that. And the procedures, go through their SOPs, the control policies, the control activities relevant to financial reporting needs to be understood comprehensively by the auditor. So step 2 is to evaluate the design of the controls. You need to ask, are controls designed properly to prevent, detect, and correct material misstatements? So if the answer is there's a poor design, you cannot rely on it. So you need to move to substantive testing, like we've reiterated properly and unequivocally in the last 2 sessions. And Step 3 speaks to testing operating effectiveness by performing test of controls, walkthroughs, samples, or samplings. You need to confirm controls are applied consistently and effectively throughout the transaction processing, postings, and recognitions on their financial statements through the ERPs. It's very important. And step 4, speaking to accessing control risk. So if controls are effective, you can rely on them. Then you adopt the system-based approach with reduced substantive testing. And that's what step 4 speaks to. But if the controls are ineffective, like we said over and over again, or unreliable, you need to use substantive testing approach, which is a more detailed transaction and balance testing. So where controls are strong, you have low control risk, then you could do 20% of the population. Maybe you have 1 million data, so you could do 200,000 data analytics. But where controls are weak, then you may have to go to 800,000 data. And that is why AI has come to stay. You have to use AI because ordinarily you cannot analyze about 800,000 transactions, maybe of a bank, normally. So you have to use data analytics or AI to help you do that. So depending on the control risk result will depend on how much substantive testing or detailed testing, balanced testing, you may call it, that you have to perform. And step 5, always perform some substantive testing, even if control risk is low. So with strong controls, you must carry out minimum at least substantive testing to validate that the little issues with human error, management override, fraud conclusion risk has been satisfied. You have that level of comfort, like we said over and again, that thus has not transpired, even those controls are strong. You have to have that level of comfort. So it's important to note keenly that your decision to rely on internal control follows this structured or unstructured part. Understand the system, number 1, evaluate design, test controls, whether weak or strong, then decide your reliance. Now, based on your discretion, you need to decide reliance and adjust your audit approach, whether you want to stay with the system-based or you want to go ahead and test substantively. This is very important. So that's the approach, pragmatically, how auditors could rely on internal controls, and that will be based on experience and also your judgment. This is very important. Okay, so that's it for Unit 3. Do we have any questions? We had to run through that so we could be fast. Any questions on Unit 3? We're going to the last unit, speaking to the Statement of Financial Position approach. Any question?
Sir,
observation, contribution? Yes, please. Yes, please.
this is not directly on audit on this topic, but it's still in the topic. I heard you saying that there are AIs to test controls. Can you just mention 1 or 2? I didn't know there are AIs that test.
Yeah. So all the general AIs we have, ChatGPT can help you do that. Gemini can help you. DeepSeek can help you. So those 3 AIs can help you do that. So it depends on the prompt. And if you're using the free version may be limited depending on the kind of data you provide. So you can't give the free version of ChatGPT 800,000 transactions to test. To tell you it's too much for it, you have to go for the AI. So if you go for the paid one, like I currently do the $20 package per month, that could even help you with 1 million data. It can generate videos, it can do a lot of walkthrough tests for you. So depending on the package, ChatGPT is good. Gemini is also good, and DeepSeek is good. So those 3 you can, but the paid version will do a more detailed job. But if you have transactions less than maybe 200, 100, 50, the free one can help you do the data analytics. So it's the prompt that matters. Just give it the prompt. I want you to test for whatever it is on this set of data. Any invoice that is duplicated, fishes out. Just give it a prompt and you'll be surprised that, wow, this thing that will take me 2 weeks to test has just been done in 5 minutes. So those three,
no one said AI is taking over our jobs, because
no, not really. That's not correct. So if you can't use the AI, the only challenge is that accountants that don't use it to be limited, but accountants that use it to be more effective, but it can't do the job of an accountant. I'll share with you that there was a test in Harvard given to AI, and I think it passed medicine, most fields, IT, and they gave it the AI exam, I think ChatGPT, and it passed. But when they gave it accounting, because accounting is more of principle-based and rule-based, AI scored, I think, less than 50%, 40% or so. Could go through that record on Harvard's website. So accounting is more of a judgment thing. So it's not a rule-based, or this is how you go, this is what you do. No. So AI couldn't decipher some things like postings, financial statements, and all that. So in answering your question, no, it won't take over our jobs. It will only take over the jobs of chartered accountants that don't embrace it. Any chartered accountant that has refused to embrace AI, I'm sorry, you may not cope in the current business space, because technology is fastly evolving. Right now, I can't even work without ChatGPT open in my office because of the level of data I work with. If there's no ChatGPT, I can't work, because it will take me time. If there's no Gemini, if there's no DeepSeek, I can't even do my job.
It takes a lot of time, honestly.
Yeah. So you need to learn it. Like the current CEO of Microsoft said, AI has come to stay, and it helps you do much with less. I love that statement. You do much with less. So that's it. So let's embrace it. I'll encourage you, please. If you're not using AI, then you are wrong. Let me use that word. You are wrong. So thank you for bringing that, Aisha. That makes a lot of sense. So please go and use AI. Even most of the things I do, lecture notes and all that, AI has to help me. If not, I won't be able to come up with some of these things. It will be hard. So everything, it's easier and less stressful with AI. So let's embrace it. Thank you for that. Bringing that to the fore. Okay, so let's run. Let's look at Unit 4, the Statement of Financial Position Approach. So we'll be looking at 3 sections, and I hope we clear this section and go into past questions quickly. So we'll be looking at substantive tests, looking at the SFP approach, and finally, smaller entities on how to perform their audits. Smaller entities, which approach is good and would save time and money and effort in addressing the issue of small entities. So just 3 sections, and I think we are done with that. All right. So we look at the first section talking about substantive tests. When do you use substantive tests? Is if your control risk is assessed as high. We've said that over and over again. High control risk is speaking to weak controls. The auditor cannot rely on it. So definitely you have to go through or perform substantive testings. So in this case, the auditor cannot use a system-based approach when control risk is high. He must perform substantive testing to see the extent of which controls have gone weak. So what are substantive tests? Somebody may ask. They are audit procedures designed to detect material misstatements in the financial statements. So that's essentially what substantive tests are. They are audit procedures designed to detect material misstatements in financial statements. The purpose is to provide direct evidence whether figures in the accounts are true or unfair. And when performing tests of substantive testing, the population is where the issue is, where you have large data sets. You have to test them to a level of, to have that level of comfort. You may not test 100%, but you have to go maybe above 60, 70, 80%, speaking to the material amounts. My supervisor calls it high values. my current audit supervisor used to say is high values, concentrate on the high values. And the purpose is to provide direct evidence whether figures in the accounts are true and fair. So we have some types of substantive tests. First one is test of details. You need to focus on individual transactions, account balances, and disclosures. So individual transactions are like postings, day-to-day postings, month-to-month, year-to-year postings, and they may be much. Then you need to test them. You need to test account balances. Do they tally with closing of this period, opening of this period? And you also check disclosures. So those are what substantive testing entails. So for example, inspecting invoices and receipts. You can export them from the ERP and check with the physical. Just keep ticking, keep ticking, keep ticking. Or you scan them, put it on AI and tell it, okay, I have the Excel exported ERP from the ERP. Here are the scanned copies. Can you match them and give me where there are mismatches? Just uploading those documents on AI, you just see that it's matching what is on the ERP with what is on the physical receipt. And it will help you confirm if they match substantively and fish out those. So where you have large data sets, you may need to employ the use of AI to really help you reduce that population or reduce the work that human effort may not be able to cover. Another example is confirming receivables with customers. This can be independently done without the consent of the process owners or management. Very important. You can also verify existence of inventory to stock counts, detailed stock counts. That will help you validate substantively that inventory exists. That's one area fraud is hidden, especially for manufacturing companies. So substantive testing, test of details could speak to these areas we just highlighted. We also have analytical procedures involving comparing data and investigating unusual trends or ratios. So your analytics are very important. Data analytics will help you use ratio analysis to see how trends are in that organization's financials. So for example, you can compare current year with prior year by using the ratio analysis like gross margin, receivables turnover, and the likes. So reasonable tests in checking interest expense, matching loan balances and rates are areas you could also use to validate or perform analytical procedures. So key points is to take note, for you to take note here is substantive testing is the direct check of financial statement figures, especially when control risk is high. So it becomes more extensive when reliance on controls is low or practically impossible. This is very important. So that's generally what substantive testings are all about. All right. So any question on that first unit? Any question, any contribution, observation? Okay, let's go. I believe it's comprehensive enough. Why is my screen freezing? Okay, it has come on. Okay, so let's look at the next unit or the next section, which is the SFP approach. This is another audit approach based on solely substantive testing. So unlike the system-based approach, it focuses mainly on balances, not on both balances or transactions. So balances are the focus of the SFP approach. It's a good approach because it helps you to nip whatever issues are in the board. Key issues, receivable balances, inventory balances, cash and bank balances. They are very good areas to take note of. And key features or the primary focus on the SFP approach is the testing of account balances, areas of assets, liabilities, and equity. And the less emphasis on the SFP approach is placed on individual transactions. So the SFP approach doesn't look generally at individual transaction. It tests account balances. So in areas of asset, you could test account balances of inventory, receivables, and liabilities. You could look at loans and equity. You want to test to see ordinary shares. So key areas are focused on, are primary focus. So it's best suited for small companies with fewer or simpler transactions, or investment companies or businesses where assets and liabilities are more significant than day-to-day postings or transactions. So the basis of this approach is that you rely on the accounting equation, speaking to opening net assets, profit for the year, will culminate in the closing net assets. This is the general equation. And the meaning is that you're trying to ascertain that opening balances are correct, then the closing balances are correctly verified. But where opening balances are not correct, then you have issues with the closing balances automatically. And it culminates in the profit for the year being incorrect. But vice versa, where opening balances are correct, closing balances are correctly verified, then you place reliance on the profit declared for the year, which must be correct. So an example, look at an investment company with large holdings in securities. The auditor verifies the existence of these securities, its valuation, and ownership of the opening and the closing investment balances. So if those opening and closing are accurate, then profit arising mainly from the changes in the value plus income will also be fairly stated. That's what this means. But where there is a dichotomy or a difference or an issue in the opening balance, then you know the closing and the profit declaration is definitely wrong. So keynote is that the SFP approach is a balanced, focused audit strategy, especially for small companies, and is useful where transactions are fewer, all these small entities, one-man businesses. Really, the SFP approach works. And the balance, where they have balances that are not high or significant, fewer transactions, the SFP works for such entities. Very, very important. Okay, so that's generally the idea of the SFP, or an idea of the SFP approach. So any questions, any comments, observations on that? Okay, let's look at, I think, the last section, speaking to smaller entities. Speak to smaller entities. Smaller entities, and speaking to how you apply ISAs to auditing smaller entities. You can apply ISAs to small audit firms or small companies. I beg your pardon, not small audit firms now, small companies, regardless of the entity size. However, even though it's not mandatory, it's voluntary that small entities get to be audited. It's not mandatory statutorily, but then where owners opt for audits, you could apply ISAs to the audit of such companies. So ISAs provide additional considerations to help auditors apply requirements in small entities. So these considerations do not reduce the auditor's responsibility to comply fully with the ISA's requirements. So that the company is small does not mean we must use another approach or another set of standards. We must apply ISAs, even though predominantly you hardly see where small entities are audited or case scenarios. Mostly it's for public listed companies, public interest companies and all that. But where they opt for audits, we need to employ these ISAs. So it's important to fully comply with ISAs in the audit of small companies. We must understand also that internal controls in small entities mostly are inappropriate. They may be too costly or impractical. That's because of the size of the company. So for example, segregation of duties as the control activities, the third component of internal control framework, may not be visible in a small entity setting. Control activity in the sense that control systems they always rely on the owner manager's involvement. You see the owner initiating, the owner is verifying, he's the same person approving. Those are the scenarios in a small company. So personal authorization of key transactions, direct review of operations, these are the norms. These are what you see. So you can mitigate some risk, but it's only a partial substitute for the formal internal controls. So these are the issues where you likely have very little staff one person may be doing 3 jobs, so segregation of duties may not be possible for small entities. And the common problems in these small entities includes issues like lack of documentation, where systems may not be formally documented. The auditor may need to rely more on inquiry and paper rather than paperwork. Also, lack of evidence of control applications, speaking to authorizations and approvals may not be documented. So those are the norms with smaller entities. You have issues of management override, where the owner manager may override the established controls, and the established controls are even maybe not documented. So these are issues. Then you have limited expertise, where management lack knowledge of effective financial control practices. Areas and issues like absence of independent oversight, speaking to no equivalent of audit committee or a governance board to report to and all that. So the implication is that the attitude and actions of the owner manager are crucial to risk assessment. So you need to depend on the owner manager's actions, and also inquiries, speaking to him on areas of controls, improvements, recommendations, and all that. So likely no formal code of conduct. The auditor must assess whether management demonstrates integrity in those small entities and ethical behavior in carrying out their business. So as auditors, we must be careful and we must carefully understand and evaluate whether controls exist, even if it's informal, undocumented, or not documented. So the keynote is that in smaller entities, the owner's involvement play a central role in controls, because they have that power, they wield power in most of what transpires in that organization. So we must, as auditors, remain cautious. Areas of lack of segregation of duties, weak documentation, risk of override can still create significant audit risk, which you must bring to the fore to these owners when we are doing or using our SFP approach or interacting to perform the audits of such entities. Okay, so that's it on small entities audit, and which approach, which is the SFP approach, is much more feasible to work or provide during an audit work for such entities. So any question? We actually had to run. Pardon me if I was very fast. That's because we need to be fast and see how to finish this chapter and move to our past questions quickly. So any questions on the SFP approach and also smaller entities? Let's review the chapter quickly. Any questions, observations, contributions? Okay, so before moving to our past questions or the next chapter, we're not moving to the next chapter now, we're looking at past questions after this. Should be able to summarize the different types of audit strategies and the factors that impact which strategy you need to adopt. So the factors are very important. And also you should be able to explain the business risk approach and be able to identify and assess business and financial risk at this point. And also you should be able to describe the system-based approach, talking about internal controls, the ERP of the company, and articulate the components of the system or of a system of internal control, speaking to the 5 elements of COSO framework. So you should also be able to summarize the SFP approach, mostly that as is used for smaller entities or recommended for smaller entities. Okay, so that's it for chapter 6. We've had a safe landing on chapter 6.